Think about this for a second. How does a massive company decide to drop billions of dollars on a new factory, or pour a fortune into developing a new drug that might not even work? These are the kinds of giant, future-defining bets that can make or break a company, and they don't happen on a whim. There's a whole process behind it. So let's dive into the high-stakes world of capital budgeting.
Right? I mean, this is the question for any big corporation. This isn't just about spending a chunk of money. No way. This is about charting the company's course for the next 10, maybe even 20 years. If you get it right, you create incredible, lasting value. But if you get it wrong, well, you might not get a second chance.
And that's really the heart of it, isn't it? The decisions we're talking about have these enormous long-term consequences. A choice made in a boardroom today could determine whether the company is a market leader or a forgotten memory a decade from now. The stakes are just that high.
Okay, so if the stakes are that high, how do you make sure you're making a smart, strategic move and not just recklessly gambling with the company's future? Well, you use a playbook, and that playbook is called capital budgeting. It's the disciplined, structured process that separates smart bets from wild guesses.
And this playbook, it has some pretty clear steps. First up, you've got to identify potential opportunities. Then you do a quick screening to weed out the obvious non-starters. Now, the real meat and potatoes of the whole thing is the financial appraisal. That's where you really crunch the numbers. If a project gets the green light, you move on to implementation and you keep a close eye on it. And finally, much later, you do an audit to see what you can learn for next time.
So, when we get to that heavy-duty financial appraisal, what's the magic number we're looking for? You might think it's profit, right? Or maybe revenue. Nope, it's cash. Cold, hard cash. What really matters is forecasting the actual cash a project is going to generate over its entire lifetime.
And listen, this is probably the single most important idea to get your head around. We only care about the incremental cash flow. In other words, we're asking a really simple question. What will our company's bank account look like with this project versus what it would look like without it? The difference between those two futures is the only thing that matters for this decision. Now, this leads to a couple of classic mental traps. First, you've got sunk costs. This is money that's already out the door. Maybe you spent it on market research last year. It's gone. You can't get it back. So it's totally irrelevant to the decision you're making today. But then on the flip side, you have opportunity costs, and these are absolutely crucial. If you decide to use a factory you already own for this project, you're giving up the chance to, say, rent it out. That lost rent is a very real cost of the project.
Okay, so this all sounds great, right? Super logical, step by step. But there's a villain in our story, and that villain is something we all know very, very well: uncertainty. Because no matter how great your spreadsheet is, the future is and always will be uncertain.
Think about it. Every single number you plug into that model, how many widgets you'll sell next quarter, the price of steel in 3 years, it's all just a guess. A really educated guess, we hope, but still, it's a guess. So what do smart managers do about this foggy future?
Well, they know they can't eliminate uncertainty. You can't. Instead, they embrace it. They use some incredibly powerful tools to understand it, manage it, and basically stress test their plans to see how they hold up. Let's look at a couple of the big ones.
First up is a technique called sensitivity analysis, and it's pretty much what it sounds like. You're trying to figure out how sensitive your project's success is to changes in your key assumptions. You take your model and you start poking it. What if our selling price is 10% lower? What if our labor costs are 20% higher? You're basically trying to find the project's Achilles heel. So check this out. This table shows us the project's net present value. Basically, its total value in today's dollars. And this is where things get really interesting. Look down at the bottom line, salvage value. If we get a great price for our old equipment versus a terrible one, the needle barely moves. The impact is tiny. But now, look at that top line. Unit selling price. Whoa. If we get our price a little wrong, the project swings from being a massive winner to a catastrophic loser. That's a nearly $3 million swing. Right away, you know exactly where the biggest risk in this project lies. So, sensitivity analysis is fantastic for finding that one big weak spot. But here's the thing. In the real world, things rarely go wrong one at a time, do they? What if a competitor launches a new product and our sales price and our sales volume both drop? For that kind of scenario, we need to bring out the big guns. And the big gun here is called Monte Carlo simulation. This is seriously cool stuff.
Instead of just testing one best case and one worst case, you use a computer to run your financial model thousands or even tens of thousands of times. And each time, it picks random but realistic values for all of your uncertain variables. It's literally like simulating 10,000 different futures at once to see the full range of what could happen.
And the result you get back isn't just a single number. It's a picture, a map of the probabilities. This chart here might tell us, look, there's a 10% chance this project actually loses money, but it also shows a 30% chance it's a huge home run. Now, as a decision maker, you can have a much smarter conversation about the real risks and rewards you're facing.
And that's really what this all boils down to. This whole process, from defining cash flows to running these complex simulations, is all about transforming what could be a blind, reckless bet into a well-understood, strategic, and calculated risk.
Let's be super clear here. None of these tools give you a crystal ball. They will not tell you the future. What they do is provide a powerful framework for thinking, for analyzing, and for making the absolute best decision you can, even when the future is a big, foggy mystery.
It really all comes down to this simple idea. You gather the best information you can, you build your models, you stress test your assumptions, and you understand the range of what could happen. The goal isn't to be a perfect fortune teller. It's simply to make the smartest decision you possibly can with the information you have right now.
You know, every great leap forward, every game-changing product, every piece of infrastructure that shapes our world, it started with a decision just like this one. It started with a team looking at a big, scary, uncertain future and saying, we've done the work, we understand the risks, and we're taking the shot. So that just leaves one question. What calculated risk would you take?